Hello investors, it's Zil from Equitymaster, bringing you investing insights to make investing simple and easy to learn. To stay updated on investing trends and the latest developments on Indian markets, don't forget to subscribe to this channel and like this video. Long-term wealth in equities is rarely created in the obvious places. It's built in businesses that are still evolving, where the future is not fully priced in, where growth is still compounding beneath the surface, and where the market's attention hasn't completely caught up. That is what makes small cap investing both compelling and uncomfortable. The opportunity is significant, but so is the need for patience, conviction, and selectivity. In a market filled with hundreds of small cap companies, only a handful will truly scale, sustain, and compound. So, how do you filter out the good ones from the vast universe? Well, a starting point could be looking at their growth rates when it comes to sales and profit. Keeping the same in mind, we have filtered 5 names from the small cap universe using Equitymaster's powerful stock screener, Small Cap Growth Stocks in India. Keep these 5 high-growth small-cap companies on your watch list as they can emerge as strong contenders over the long run. Now, before we move on, please note that this video is for information purposes only. It is not a stock recommendation and should not be treated as such. There is no opinion or view on any stock covered herein. With that disclaimer out of our way, let's get started. First on the list is SG Mart. SG Mart was acquired by Dhruv Gupta and Meenakshi Gupta in April 2023. The company currently trades in more than 1700 building products and derives the bulk of its revenue from HR coils, CTL HR coils and TMT bars. It is becoming a key player in the construction sector and has positioned itself as a one-stop solution provider for all construction needs. Ever since the acquisition in 2023, the company has seen a healthy ramp up in its business. The current promoters have made sustainable efforts in a way of offsetting the impact of falling steel prices and have been focusing more on launching value-added products. This effort has trickled down to its financials numbers. Over the past 5 years, its sales and net profit have grown at a compounded annual growth rate of 738% and 194% respectively over the past 5 years. The return on equity and return on capital employed have averaged 4% and 7% during the same time. Going forward, the company's management is expecting its revenue to grow double digits in the next 2 fiscals between fiscal 2027 and fiscal 2028, driven by ramp up of its service center segment. The company currently has a healthy and growing network, and its products are supplied throughout India via 680 dealers operating through 7 cut-to-length service centers. The company plans to add 5 more stations by the end of fiscal 2027. As CTL is a value-added service, this segment is likely to support future growth. Now, second on our list is Blue Cloud Solutions. The company operates across high-growth verticals including digital health, AI diagnostics, advanced sterilization, 5G fixed wireless access, cybersecurity, and enterprise telecom, supported by a structured SPV-led operating model. Currently, close to 75% of its revenue comes from the security segment, followed by 10% from the healthcare segment, 10% from support services, and 5% from the education segment. In recent years, the company has been looking at inorganic route and growing through acquisitions. It recently announced the proposed acquisition of 100% equity stake in Global Imbex Incorporated from ConnectM Technology Solutions Incorporated. Moreover, it acquired 100% equity shares of AIS Anywhere USA. While it remains to be seen whether these acquisitions will support future growth, this strategy has paid off well in the past and is evident from its financial numbers. In the past 5 years, sales and net profit have grown at a CAGR of 502% and 470% respectively. The average ROE and ROCE remained at 13% and 15% during the same time period. For FY27, the management has projected revenue to reach 30 billion rupees. And recently in March 2026, the company received a work order for the supply, installation and commissioning of AI-enabled high-performance computing infrastructure. In the same month, it even received a purchase order from Central Electronics, a Government of India enterprise, for the deployment of its Access Genie AI platform under the Telangana Arogyashree healthcare program. Moreover, it has even invested in the data center infrastructure. The company has outlined a phased investment plan of up to $1 billion to build a nationwide AI-driven data center and digital cloud infrastructure platform in India. It's targeting up to 800 megawatt capacity over the long term. The initiative is aimed at strengthening digital infrastructure while supporting enterprise digitalization, national security and advanced computing needs. Third on our list is SG FinServe. SG FinServe, originally known as Mungipa Securities, was established in 1994. In 2021, the promoters of APL Apollo Group had acquired 56.25% stake in the company. It's an NBFC focused on supply chain financing aimed at optimizing working capital across corporate ecosystems. It operates largely within and beyond the APL Apollo Group ecosystem, enabling credit access across the value chain. The company follows a partnership-driven model, sourcing business through banks, NBFCs, lending service providers, payment aggregators, and referral network comprising DSAs and arrangers. SG FinServe operates across 30 plus locations in India with strong presence spanning the north and in North Delhi NCR, Punjab, Rajasthan, west for Mumbai, Ahmedabad and Pune, south for Bengaluru, Chennai and Kochi, and east for Kolkata and Guwahati. Its AUM has grown steadily. As of December 2025, it reached 32 billion rupees, 105% year-on-year growth. Sales and net profit have grown at a CAGR of 715% and 369% respectively over the past 3 years. The average ROE during the same period stands at 8%. And going forward, the company has ambitious plans to take its AUM to 75 billion rupees by FY30. The company is strategically important to the APL group, so it's expected to receive managerial, operational and financial support from the group. Fourth on the list is SAR Televenture. The company is a certified telecommunication infrastructure provider. It installs and commissions telecom towers in India. So far, it has installed more than 413 towers on lease in West Bengal, Bihar, Uttar Pradesh, Chandigarh, Odisha, Jharkhand, Himachal Pradesh, Punjab and Andaman and Nicobar Islands. Apart from this, it also provides support services across the optic fiber value chain and project turnkey services to various telecom network operators and broadband service operators and ISPs. Further, the company has even started installing fiber to the home, that is FTTH, which is a broadband internet connection technology that uses optical fiber to deliver high-speed broadband internet directly to households. Coming to its financials, the company's sales and net profit have grown at a CAGR of 320% and 981% respectively over the past 3 years. Its ROE and ROCE have averaged 20% and 14% during the same period. Going forward, the company is actively looking to partner with top real estate developers and deliver smart connectivity solutions. It also has a wholly owned UAE subsidiary, SAR Televentures FZE, which undertakes fiber cable laying and network equipment supply. The company has recently made 2 acquisitions, which are expected to boost its future growth. Last on our list is Raymond Lifestyle. Raymond Lifestyle is the flagship company of the Raymond Group. The company offers fashion products and services with branded textile and apparel brands across formal, casual and ethnic wear. It has a track record of over 10 decades in the industry and a healthy brand image, plus a large retail network. Well, Raymond is India's largest manufacturer of worsted fabrics and wool blends and holds a market share of 50 to 55% in the suiting segment. It has a store count exceeding 1,675. Its flagship brand, the Raymond Shop, has a network of 1,105 stores across 600 cities. Coming to Raymond's financials, the company's sales and net profit have grown at a CAGR of 285% and 31% respectively over the past 3 years. The average ROE and ROCE during the same time have been around 8% and 11%. Looking ahead, the management is committed to becoming a leading fashion and textile company under its Raymond Lifestyle 2.0 vision. To this end, it plans to strengthen the core, accelerate growth, and create new categories. Raymond is betting big on ethnics, which now operates around 140 stores across India. This business is expected to take 4 to 5 years to become strong and sustainable. The company is also expected to benefit from the India-UK Free Trade Agreement, which will ensure zero duty access for 99% of Indian exports. While investing in small cap growth stocks requires catching trends early and backing businesses with the vision and scalability. Companies with strong fundamentals and strategic positioning will be the ones creating lasting values. Of course, the journey won't be linear. Markets EVB and flow, and even the best stocks face periods of volatility. But for investors willing to think long term, the right mix of resilience, innovation, and growth rates can unlock significant returns. That said, investors should always evaluate the company's fundamentals, corporate governance, and valuation of stock as key factors when conducting due diligence before making investment decisions. That's it for today. Don't forget to like this video and share it with your friends and family and make them as smart as you are. This is Zil from Equitymaster. Thanks for tuning in.